Welcome to the Growth Xperts Podcast. I'm your host, Derek Colin, and today we have a special guest on this episode. His name is Michael Warren. He is the founder and managing partner of Alethia VP. How are you doing today?
I'm good. How are you, Derek?
I'm good. So can you share a bit about your role and how it fits into the bigger picture over at Alethia Venture Partners?
Sure. A few years ago, after leaving private equity firm that I had been with for a couple of years, I decided to venture out into doing more venture capital instead of doing private equity, which I really didn't enjoy. I'd spent about 20 plus years in the securities industry, in the investment banking side, broker dealer side, RIA, and other areas in the securities world, financial planning, stock brokering, all that stuff. I eventually got into the private equity side, and I figured out real quick that I didn't want to own anybody's business and I didn't want to run anybody's business. I really just wanted to invest and advise and help companies grow to exit. And so I started the firm a couple years ago with 3 other partners, and we decided we wanted to go in a certain vertical. That vertical happened to be CPG and beverage. And we've subsequently grown from 1 fund into 2, and now we've got a tech fund that does health and wellness tech, bev tech, real estate tech, and a few other things, including AI and other technology, fintech type of products. So I founded the company and brought all the partners in.
Oh, nice.
Yeah.
How long ago did you found the company?
2.5 years ago.
2.5 years ago. And what's your investment thesis? How are you identifying these tech companies and bringing in partners and all that stuff? Can you share?
Yeah, well, it's interesting, right? The last 2 to 3 years have been very difficult to raise capital. Various reasons out there. Interest rates, not a lot of liquidity events, political issues, both in the US, worldwide. We noticed that a lot of family offices and a lot of high net worth individuals really wanted to hang on to their money, especially with the interest rates at a high rate, where they didn't have to take a lot of risk in taking on investments. Along with that, what you have is an inverse of valuation. So when people stop investing, companies start having a harder time raising capital, and a lot of them have to slash and cut their valuations just to attract investors. And so part of our thesis is finding great companies with great leadership that are young and growing, even in a difficult market, but they've reduced their valuations to an area where it's more palatable to invest in, where we get a bigger upside. So a lot of the thesis that we have is wrapped around taking advantage of opportunity right now in depressed markets. And that includes beverage, CPG, and many of the tech sectors that are not AI driven, that are still infrastructure type of companies that support all the newest and latest, greatest type of stuff.
Oh, okay. Interesting. So I assume you go into these companies from a corporate governance perspective. You look at what's working, what's not. Do you implement AI yourself, or do you have a team that does that?
So it's interesting. The first thing we look at when we go into any company and start doing due diligence is, do they have a competent and a good leadership team? So it starts with people for us. It does not start with the product, service, or anything else. Yes, we are sector driven, but I really look at who's running the company, who's managing the people, who's in the leadership roles. Are they competent? Do they have experience? Have they run companies before? Are they just a new founder that liked the space and decided they were going to do something totally different in life? So everything starts with the founders. AI does not play into that initially, but once we get into the due diligence process, yeah, AI absolutely plays a critical role in it, because we run a lot of what they're doing through AI to see if their business models are working, to see if their sales channels are the right avenues, if they're using marketing the right way, if they're able to identify their customers properly. And AI does a really, really good job on that. Now, AI isn't the end all to end all, and it doesn't dictate what we do, but yes, it definitely plays a certain role in what we're doing, especially in the tech companies. Beverage, it's a little different. Beverage is still one of those feel good consumer type of product that you just have to have a feel for it, and you got to see if people like it or not. And AI is not going to give you a lot of predictive models in that space that haven't already been done for the last 100 years, right? But in the tech sector, yeah, we use AI a ton. On every one of the tech companies that we are in due diligence with or we're raising capital for, I run a lot of AI models through every single one of them. Absolutely. Yeah.
So cool. Awesome. So when you talk about AI models implementing those types of, technology into your portfolio, what major shifts are you currently seeing now in your industry?
Well, I mean, listen, let's be honest. The biggest shift that we've seen in the last couple of years is AI itself, right? So where we might have been due diligence and I had 3 or 4 people, running models. I'd have a CPA doing one thing. I'd have a tech guy doing another thing. I'd have somebody specific for that industry. We don't have to do that. It's actually cut down on my human capital costs and the costs that get transferred onto our limited partners that are paying expenses based on what my overhead is eventually in the,
Yeah.
how the waterfalls roll down. So, the technology piece that has made a huge difference is that AI piece. Our attorney, Zach Capra, even on our legal documents now, we can produce legal documents for a client in a couple hours instead of weeks. I mean, it's made a huge difference. So when you're doing a deal where you have to go 30, 40, $50,000 usually in due diligence fees and papering a deal, we can do that for less than $10,000 now per deal, which saves our LPs and saves our portfolio companies a ton of money. So that has been easily the biggest shift that we've had is the AI implementation into due diligence and documentation.
Oh, interesting. Awesome. Very cool. So when it comes to due diligence and documentation for that specific AI shift, are we talking like customer information memorandums as an analyst OS? Are we talking about 50-page documents here? Is it within compliance? Like how does that work? Or does it
Well,
make
yeah,
your analyst jobs easier?
you hit on all of them. Okay, so the analyst is definitely one of the things, right? You can plug models into AI and it will analyze the market across data points that, if it was only a human doing it, would probably miss 30 or 40% of that. So it has definitely changed how we do the due diligence process. From a legal process, it allows us, yes, to create a PPM. You would normally go to an attorney and have them create a PPM and it would take them,
Yeah.
weeks to do it. You'd have a 50, 60, 80, 100-page document, depending on how involved it was. AI, we literally can produce a PPM in minutes now, not weeks or days or months. We do it in minutes. And, from a legal perspective, if you're an attorney and, your billable hours towards the firm are going against the returns of the investor, you want us doing that. You want us using AI. You want us producing documents as fast as humanly possible at the least cost. So it speeds up the process tremendously.
Yeah.
Now, it doesn't mean that they are any less, good for that matter. The AI produces some of the best stuff, but we still go over it manually as human eyes to make sure everything's done right. But yeah, you do a offering memorandum, you can do, the LPA very easily. You can create the subscription agreement so fast.
Yeah.
It's not even funny. Like I can get a full set of docs out from our attorney in a day. And
Yeah.
it probably is a day. It was 2 hours of plugging in what we needed in the prompts, and then a couple hours of review to make sure that everything is in there. We didn't miss something, right? So it's good. But also from a compliance standpoint, we were able to do compliance way faster. We're able to do accounting faster. We're able to do, we haven't gotten into distributions yet, but once we get to the waterfall and distributions, I'm sure all of it will be AI driven. I mean, every program that we use within the fund structure, from our client facing type of technology to the back office, every bit of it is AI driven, all of it now. And it's only going to get more. I mean, it's going to get to the point where, where you might have needed 6 or 7 people in your, as analysts, as hiring a bunch of MBAs, from Wharton and Harvard and things like that. I see more resumes that come to me from those guys now because they've been let go from firms that were paying them a ton of money to do something that they can do AI generated, in minutes now. So it's impacted the entire venture capital world, private equity. I mean, I sat with a big private equity company a couple weeks ago in a meeting. We were in an M&A meeting, and they had flown two guys in from San Francisco, a guy in from Dallas, another guy in from Utah, and it was just me and the company owner working through the deal with them. And I looked at their due diligence sheet, and I knew in 2 seconds that it was completely AI generated. It had every question that I've seen in my own due diligence stuff. And so we spent several hours in that meeting. And at the end of the meeting, I said, "Why are all four of you here?" And they said, "Well, our firm still likes the eyeballs and understanding the ownership and the roles everybody plays." And I said, "Yeah, but how much of this was done in AI?" They're like, "All of it. The entire," and this is a $3.5 billion fund, right? This isn't like like a Mike Warren, a couple of small venture funds. This is like, these guys are on their fifth fund. They've got $50 billion in AUM. I mean, it's serious. And they're using AI predominantly for their due diligence. And the only thing they're doing is sending out physical people to make sure that the company actually exists. That's kind of what they're doing. And a lot of people are doing that. So the landscape has changed so much. And I'll tell you, Derek, it's changed more, I think, in the last year than it has in the last 26 to 27 years that I've been in this industry.
It changes fast, like hour by hour now.
Hour by hour, man, it's insane.
Yeah.
Like
it's speeding up.
Yeah, it's crazy.
I remember in 2021 when I was running PE firm, the PPMs were hard to create on your own, and they had guides and stuff, and you could do it on your own manually. But I didn't have the AI I needed in 2021 to do it for me. You know what I mean? Yeah. And I had to look at paying some certain people, and then you had your cheap ones where they're like maybe $500, but you still didn't get that certification that you needed from like a law firm that can specialize in putting that together for you when you need the right type of funding. Because if the PPM ain't right, people will laugh at you. You know what I mean?
Well, not only that, but if your PPM isn't tight, you're open to lawsuits and exactly. So many different ways. And I know we could go down that rabbit hole, but that the legalities that you need in your documents to protect you. Yeah, you used to need a law firm with a lot of people writing all that stuff, but you can literally take a PPM from anybody. You could feed it into an AI system. It will recreate it and just change the parameters, but it'll have all the same legalese and everything else. And listen, let's be honest, attorneys have been regurgitating the same PPM for 30 years. They just changed the names and some of the other stuff. But now, and that used to take them a lot of time to do because they'd have to go through it line by line. Now you don't have to do that. You just plug a couple things into the prompts and it's already there. And it's got everything state specific, country specific, filing specific, everything.
Could you explain to those who are listening what a PPM is, a private placement
memorandum? It's a private placement memorandum, and it's basically a bunch of pages on how you can lose your money and what the recourse is. But it explains what the deal is. It tells you who's managing the company. It tells you a lot of things. In a fund, it's not company specific, it's fund specific. But if you're getting one from a company, it gives you all the disclosures, the legal disclosures that, again, I break it down into simplicity, which is it tells you a million ways on how you can lose your money. That's
definitely.
So
Mike, what's working well for you right now and what's been frustrating?
Oh, wow. That is the greatest question and so loaded. I mean, let's go with what has not been working and what's been frustrating. And what's been frustrating is really the state of the market. Okay, we got a stock market that keeps hitting highs, but we have interest rates that are still high. And so people with a lot of money do not have to take a lot of risk. So we've seen a lot of IPOs that were scheduled that have been taken off the shelf. We've got a lot of companies that need money but are having to pay usury rates to get that money. So if you're borrowing money, you're not getting it cheap right now. And the more you need, the more expensive it is, and so LPs out there, limited partners for your audience, or high net worth individuals, family offices, funds of funds, pension funds, they're being more picky about where they land their money. And so the due diligence process has increased from a couple of months upwards of 6, 7, 8, 9 months. I mean, listen, I've got a couple of deals right now. I've been doing due diligence on them for over a year. I want to see
Yeah.
if they can survive some of the market downtrend that we've had, some of the challenges that we've had. So I
Right.
don't pull the trigger all that fast either. I sit on deals for a long time just because I want to see, do we have the proper operators in there? Do they know how to manage their cash flow? Do they know how to manage their people? And so the frustrating part is I've got more deals than I have money. And that is really kind of the market right now for a lot of lower to middle funds like myself. We see 5 to 8 deals a week, not a month, not a year,
Mhm.
5 to 8 a week. My
Yeah.
inbox is filled with deals. Or I'd like to see is my inbox filled with investors. That would make my life really great, right? So the frustration is that there is a ton of money out of the marketplace sitting on the sidelines, not being put to work because interest rates are too high right now. And when interest rates are high, people don't have to take risk. So the alternative investment space like real estate or oil and gas or some of these that spit out dividends and distributions, people are only going into the ones that are absolute guarantees that they're going to get paid. So venture has taken a hit. Private equity has become more, they're more careful. And the investors have been sitting on the sidelines for going on 3 years now. So until we see a Fed rate drop, until we see the rates drop, I don't think you're going to see an influx of, venture money going into deals that are not either, cash flow positive or at the very least break even. It's very, very tough for a startup to get the funding they need unless they're in the AI space and maybe one or two other sectors that people feel, that are almost a guarantee for the future that something good is going to happen. So that's the frustrating part. The good part is, the market is starting to break open. We're having more conversations. We have a lot of investors who are seeing that we will have interest rates going down. And when the inverse happens, right? So when the interest rates come down, now the valuations go back up. So you have this really interesting interlude that you have to play very carefully, which is if you wait till interest rates come down, you're going to overpay for companies again. If you sitting here on cash and you're making money, you're getting deals on deals right now. So there's a little space in between that you have to start the process earlier in the game than wait. So if you are sitting on cash and you wait till interest rates come down, you're going to go back to valuations that are not favorable for you to get as big a return as you could if you scooped up some of these companies right now. So I tell people all the time, you should be diversified in your portfolio. You should have a percentage in alternative investments. We've seen, many of the big wirehouses now we're going up to 25 and 30% in people's portfolios in alternative investments. I think now is the time to strike. I'm not just saying that because I run a fund and we're looking for money. I'm saying that from an economic standpoint, which is if you wait till rates come down and now you want to get in alternative investments, you're not going to get the rate of return that you could if you put money to work right now. You get in there when we can steal valuations on really good companies that are still doing great business, they're cash flowing, or they're very near break even. And as soon as you put some fuel on that fire, bet you at a low valuation, man, your return on investment is not 1 or 2 or 3x. Sometimes it's 5, 7, 10x. And that's really where you want to get to.
And if it's 5, 7, 10x, how long does it take to see that return?
It just depends on the stage of where the company's at. I really like to get into deals where the valuations are 150 million or under. And really, I like to get into those deals where they're 75 million or under. I've got a couple that are, at the 100, 150 valuation mark, but most of our deals are between $5 and $25 million of valuation. So getting 5, 7, 10x on those, you're probably looking 5 to 7 years on them. If you went in later stage, you're obviously going to get a lower return. You're going to pay higher on the valuation, but you might have a little less time of getting your money back. Again, it's a game, right? If you can sit and wait a long time, great. We can put that money to work. But if you want something shorter, you got to go into companies that are more mature that you're going to pay higher valuations into.
And is there ever a time within that 5 to 7 year mark before the exit when you decide that it's important to do an IPO to, increase the valuation, or?
That is such a loaded question. Here's
It is.
and
It is.
and here's why. I came from the broker-dealer investment banking world. We had taken a bunch of companies public. We had taken a bunch of companies private. We had capitalized on the public side, capitalized on the private side. I would say that if you really want to go the public route, which I tell most companies that I deal with, don't go down because of time, cost, risk, and risk from the market, risk from just a lot of places, the reporting requirements, what you have to do for the SEC, for FINRA, for SIPC, for all of the regulatory agencies. Unless you're really doing a lot of revenue and you have a growth pattern that could, turn millions into, let's call it billions or hundreds of millions, I think the public exit is one of the worst places you can go. I really do, in this day and age, especially in the lower level markets. If you're going onto a big board, it means you've put the time in, you've got the revenue, you've got the proven team. Yes, but for most of the companies that I deal with, I like them to exit before they get public or be acquired by a public company and not go down the route of getting public. Now, with that being said, a lot of brokers out there, a lot of VCs, a lot of companies, they dangle the carrot of, we're going to IPO because they think that's going to get them investors and money quickly, because the market has been conditioned. Retail investors have been conditioned that if it's not on the New York Stock Exchange or it's not on NASDAQ, it's too risky, which is it's completely false. All the money is made before a company goes public. By the time the company goes public, so much of the early stage win has been sucked out of it, right? So where you get your 5, 10, 20 X's is not when it goes public. It's when it's started and you put money into a seed round or a pre-seed round or a Series A. Because by the time it gets public, there's probably been between 3 to maybe 10 or 12 different rounds of financing that's gone into it. You've already 5x'd your money before it goes public. And by the way, if it goes public, there's no guarantee that's going to go public and go up. Yeah. Many companies go public and their stock stagnates or goes down for a long time before it ever goes up. This isn't SpaceX, it's in things like that. The normal market doesn't operate like that. So being public, in my opinion, as a smaller company is a detriment than it is selling that company when you 5 or 10x'd it from inception. I think that's a better way to go. And I've been through all of those. I mean, our firm was part of the Facebook IPO. Well, Facebook came out and went down and we got crushed, right? So even the shares that we had gotten pre-IPO, we didn't get the money out of them that we thought we would. And so we had to sit and wait till Facebook went back up before we could liquidate to make any return. Now, had we been at Facebook in the very first round, or second round, when they were raising capital earlier in their day, we would have had a 30x, right? Yeah. But if you come in on an IPO or you sell to people with that mindset that they're going to make a bunch of money on an IPO, get in now. Those are super highly risky,
very risky
moves.
Yeah. The market dictates the price, and as soon as you open it up to the public, people are emotional. It goes up or it goes down. It's a roller coaster, right? and then it disrupts your cash flow.
Yeah. I mean, look at Google opened up this morning, $25 up. I don't know where it's at now, but within an hour, it was already down $8, right?
No, so as for the S&P 500, that's completely different, though.
Totally different. But from a volatility standpoint, the market dictates. Listen, market dictates on an IPO, but also the program trading dictates all stock movements now. I don't know what the percentage is, but it's so high that the program trading from funds and AI trading, they do most of the work anymore. You're not gonna get the information as a retail investor before a hedge fund does. The hedge fund's gonna is going to have a millisecond before you, you're going to be following all the time, which is why I tell people, oh yeah, you want to go IPO, great, but you are open to a lot of issues going in there, and you will lose control of your company stock pretty quick after an IPO. Even if you own big, large blocks of it, you're still not going to have the control. There's market makers out there. There's program trading. I mean, I could go into the, the trading investment banking side all day long, but to answer your question, I don't ever tout IPOs for any of our portfolio companies or our funds. And I never advise them to do it either, unless they're at a stage where it would make money to raise a lot of money and they had a very good underwriting team and a good retail operation to get that stock out in the marketplace, for sure.
So to close things out, what do you want investors to know? Because you said you got tons of deal flow coming into your inbox. You need more investors. What would you like them to know about Alethia Venture Partners?
Couple things. Number one, we've been through several exits as a team, individually in different aspects of our career. I've got one of the best investment teams I think I've seen out there. We get deals before they ever hit the market. We're one of the first firms out there that sees some of these deals, and they are really good. We get a lot of deals where we are exclusive on them, and we don't have a lot of access in other through us, but we've got things that are leading edge technologies and very, very high level type of products out there. Everything we touch is better for you, is premium, and is something that's going to better the world in some way or another. And that even goes to some of our products in our beverage fund, which are alcohol products. They're still better for you products, even though they've got something in them that society might say, oh, alcohol is not good for you. Well, we could debate that on a whole different level, but we have some amazing things going. We're building momentum, and a few of our companies within our portfolios right now, I think we're going to have exits within the next 3 to 5 years on a couple of those companies, those portfolio companies. So we got a couple good things going. Yeah.
Awesome. Well, Michael Warren, ladies and gentlemen, managing partner at Alethia VP. If you guys want to check out his information, it is going to be in the description below. That is www.alethiavp.com. Thanks for joining us, Mike.
Thanks, Derek. Appreciate the time.
Pleasure.